What just happened between the United States and China wasn't a diplomatic breakthrough. It wasn't a reset. It wasn't even a moment of calm. What we witnessed was something else entirely, something the headlines won't say aloud. It was a collapse, a political and economic retreat, unmeasured, unplanned, and unmistakably reactive. For over a year, the two powers were locked in a tariff war meant to reshape global trade. Each round escalated. Tariffs climbed, rhetoric sharpened, threats became policy. Washington pounded its chest. Beijing stood firm. And then, without warning, the United States folded, not strategically, not subtly, but suddenly and quietly. One day, the administration was all in. The next, it wasn't even in the room. Markets didn't expect it. Analysts didn't predict it. Even those warning that the pressure was building didn't foresee the speed of the reversal. Make no mistake, this wasn't a calculated pivot. It wasn't a clever move in a long game of statecraft. It was a white flag, raised under the weight of domestic strain. Behind closed doors, this wasn't negotiation, it was capitulation. Washington gave in not to diplomacy, but to inflation, to rising prices, to faltering consumer confidence, and to the weight of a system buckling under its own contradictions. China didn't blink. It didn't compromise. It didn't move. It waited. It watched, and it let the pressure mount. Yes, China took hits, significant ones. Exports to the U.S. dropped over 20%, but its global trade kept rising. Total export revenues grew 8%. China wasn't paralyzed. It adapted. It rerouted trade to Europe, Southeast Asia, Latin America. The rest of the world kept buying. While Washington flinched, China evolved. What we're calling a pause is really a symptom of a much deeper transformation, one that had been underway not for months, but for years. In 2008, China's exports to the U.S. made up nearly 8% of its GDP. Today, that figure is below 0.8%. That's not a dip. It's a deliberate shift in economic gravity. China is no longer tethered to American consumption. It has diversified its markets, expanded its domestic consumer base, and repositioned itself, not as a subcontractor to the West, but as a sovereign engine of global commerce. Meanwhile, the U.S. remains deeply dependent on Chinese manufacturing. American consumers rely on low-cost Chinese goods to keep prices bearable. U.S. industries rely on Chinese components to build everything from semiconductors to heavy machinery. As tariffs rose, that balance fractured. Let's be honest. If the trade war were poker, the U.S. sat down loudly but played inconsistently. China dealt the cards, held the chips, and dictated the pace. U.S. tariffs changed like weather, 145% one week, 80% the next, then 34%. No rhythm, no clarity, no strategic coherence. Just reaction. Reaction to headlines. Reaction to markets. Reaction to political noise. As tariffs rose, inflation followed. Consumer prices surged. Margins shrank. Growth slowed. And throughout, policy remained confused. Trade war one day, compromise the next. The message wasn't strength. It was disarray. Eventually, something had to give, and it did. But it wasn't China. The so-called deal that followed wasn't a resolution. It wasn't a treaty. It was a 90-day timeout, a pause dressed up as progress. Tariffs on Chinese goods fell from 145% to 30%. In response, China nudged its tariffs on U.S. imports from 5% to 10%. A minor adjustment, not a breakthrough, just a cooling gesture, not a climate shift. Yet it was spun as a win, a victory, a triumph of negotiation. But what exactly was secured? Higher prices for American consumers, disrupted supply chains, persistent inflation, and a Chinese economy that just keeps moving. The deeper imbalance lies in the nature of the trade itself. China exports high-value, complex goods, electronics, semiconductors, telecom infrastructure, industrial hardware, the pillars of modern economies. The U.S. couldn't afford to block them completely, so it didn't. Quiet exemptions were made. Certain imports continue to flow under the radar. No press releases, just quiet survival. Meanwhile, America exports mostly commodities: soybeans, oil, wheat, replaceable, interchangeable, already being replaced. China isn't waiting for the U.S. to get its act together. It's buying from Brazil, from Russia, from Saudi Arabia, and it's doing so outside the U.S. dollar. That's not just trade diversification. It's a direct challenge to dollar dominance. If the dollar loses its central role in global trade, the edge that underpins American economic power dulls sharply. And through all of this, China hasn't even played its biggest card: rare earth minerals, essential for everything from microchips to fighter jets. When China halted exports, prices surged, supply chains buckled. American industries felt the shock immediately. Then, without fanfare, China resumed shipments. No press conference, no announcement, just quiet recalibration. And that silence spoke volumes. This wasn't a tactical adjustment. It was leverage, applied precisely, without noise. Something changed behind closed doors. An understanding was reached, and all signs point to one key concession: the U.S. stepping back from challenging China's currency controls. That's no small shift. Currency manipulation remains one of Beijing's most powerful tools. It enables China to boost exports, stimulate domestic consumption, and steer economic momentum on its own terms. And now, that power goes unchecked. Markets understood the signal immediately. U.S. equities rose modestly. But Chinese markets surged, up 3% in a single day and 16% on the year. Not on speculation, but on the back of calculated geopolitical advantage. American corporations saw it too. The so-called decoupling movement? It's already losing steam. Manufacturers are drifting back to China. Supply chains are reorienting, not out of loyalty, but for the same reason they went there in the first place: stability, cost efficiency, and predictability. If you're a CEO protecting your bottom line, why gamble on policy chaos when China still delivers? That's the real cost of the so-called pause. It's not just about tariffs. It's about trust, about credibility, about long-term planning, and whether anyone still believes the U.S. has a steady hand on the wheel. On the surface, markets may seem to be breathing easier, but underneath, the bond market is flashing warnings. Yields are climbing fast. The 2-year Treasury is brushing 4%. The 10-year, 4.5%. The 30-year is nearing 5%. This isn't healthy growth. It's capital flight. Investors are offloading U.S. debt. Why? They see the signals: persistent inflation, record deficits, political dysfunction. They're not running to gold, not to real estate. They're sitting in cash, waiting, watching, hedging against whatever comes next. This kind of divergence, soaring equities and collapsing bonds, can't last. One of those markets is wrong. And when the correction hits, it won't be gentle. Still, the U.S. offers no coherent trade strategy. One day it's tariffs. The next, exemptions. 1 month it's decoupling. The next, handshakes and vague promises. This level of policy instability doesn't just rattle markets. It paralyzes them. If you're a global business considering relocating to the U.S., what's the incentive? If China remains cheaper, faster, and more stable, why move? The hard truth is this: the so-called deal wasn't struck from strength. It was made under pressure. China held its ground. The U.S. stepped back. And now, as the dust settles, no one's asking who signed what. They're asking who held firm, who walked away stronger, who dictated the pace, and who simply couldn't keep up. Beijing didn't need a press conference. They didn't need photo ops. What they needed was patience, leverage, and timing. And they used all three. While America bought itself time, China bought influence. And the next move? It's already in motion.